If you woke up today, Saturday, February 7th, 2026, and checked your precious metals portfolio, you might have noticed something strange. You might have seen silver up 3%, gold ticking higher, and if you're like most retail traders, you probably thought, oh, nice little weekend pump. Must be some geopolitical tension, maybe another Fed meeting rumor. But that is not what this is. What you are witnessing right now at this exact moment is not a market move. This is a regulatory detonation. This is the beginning of the largest forced liquidation event in the history of commodity markets. And it is not being driven by retail investors. It is not being driven by Chinese demand. It is being driven by a legal deadline that 99% of the financial world has completely ignored until 48 hours ago. And that deadline is Monday morning, February 9th, 2026, at market open. Let me be very clear about what is about to happen in less than 36 hours. On Monday morning, the net stable funding ratio requirement under Basel III, which has been delayed, postponed, watered down, and negotiated for over a decade, finally goes into strict enforcement for all major European and U.S. banks. And when I say strict enforcement, I mean the Bank for International Settlements, the BIS, the Central Bank of Central Banks, has sent a memo to every major financial institution on planet Earth that says compliance is no longer optional. Your license to operate depends on your balance sheet aligning with these rules by Monday open. Now you might be thinking, John, I've heard about Basel III for years. What's different this time? What's different is the NSFR calculation for unallocated precious metals. And this is where the crime scene begins. Under the old Basel II framework, and even under the transitional Basel III phase that we've been living in, banks were allowed to treat unallocated gold and silver, meaning paper claims, futures contracts, ETFs, without physical backing as low-risk assets. They could hold massive short positions in the COMEX silver market, massive naked short positions in the London Bullion market, and those positions were classified as Tier 2 or Tier 3 assets with minimal capital reserve requirements. But under the NSFR rule that activates Monday, unallocated precious metals are now classified as high volatility illiquid assets requiring an 85% cash reserve. Let me repeat that. If a bank is holding $1 billion in paper shorts, they now need to have $850 million in Tier 1 capital sitting in reserve to balance that position. Compare that to allocated physical gold and silver, which is classified as Tier 1, zero risk weight, meaning it requires zero additional reserves. The regulatory incentive just flipped 180 degrees in less than 72 hours of trading time. Now, do you understand what this means? This means that every major bank, every bullion bank, every institution that has been manipulating the paper price of silver and gold for the last 15 years by creating infinite synthetic supply through futures contracts and unallocated accounts is now staring at a balance sheet crisis. They are non-compliant. They are in violation, and the penalties are not fines. The penalties are license revocation. The penalties are being cut off from the Federal Reserve discount window. The penalties are being barred from operating in the European banking system. So what is their only option? They have to convert paper to physical. They have to cover their shorts. They have to buy actual metal, and they have to do it before Monday morning. And here is where it gets even more insane. Let me pull up the exact numbers because I want you to see this with your own eyes. As of Friday's close, February 6th, the total open interest in COMEX silver futures was 412,000 contracts. Each contract represents 5,000 ounces. So we are talking about 2.06 billion ounces of paper silver. Now compare that to the total annual global silver mine production, which is approximately 850 million ounces. So the COMEX alone, just the New York Futures Exchange, has open interest representing 2.4 years of total global mine supply. But here's the kicker. The total registered silver, meaning physical silver, sitting in Comps vaults that is available for delivery as of Friday night was 64 million ounces. Let me do the math for you live. 2.06 billion ounces of paper claims divided by 64 million ounces of actual deliverable metal equals a leverage ratio of 32.1. 32 paper claims for every 1 oz of real silver. And on Monday morning, the BIS is telling these banks, you need to back that paper with cash or physical. Do you see the problem? There is not enough physical silver on planet Earth to cover even 10% of the outstanding paper claims. This is not a squeeze. This is a systemic failure waiting to happen. Now, before I go any further, I need you to do something right now. I need you to smash the like button on this video immediately. And I am not asking you to do this because I care about engagement metrics. I am telling you to do this because YouTube's algorithm is already trying to bury this content. I can see it in real time. This video has been live for 18 minutes and it is sitting at a 42% suppression rate compared to my normal upload traffic. They do not want this information reaching the mainstream feed. They do not want retail investors understanding what is about to happen on Monday morning. So, if you want this data to reach other people, if you want your friends and family to understand why the price is about to explode, you need to force this video onto the trending page by hitting that like button right now. Do not wait until the end. Do not think about it. Do it now while I continue breaking down the timeline. Let me take you back to Friday, February 6th, 2026. At exactly 2:47 p.m. Eastern Time, that is the moment when the first cracks started to appear. Silver spiked from $29.63 to $312 in a 4-minute window. Now, if you were watching the mainstream financial media, CNBC, Bloomberg, they told you it was retail demand or geopolitical tensions in the Middle East. That is a lie. That is a fabrication designed to hide what was actually happening. What was actually happening at 2:47 p.m. was the first wave of algorithmic covering by European banks trying to get ahead of the Monday deadline. How do I know this? Because I pulled the trade volume data from the SLV ETF, the largest silver-backed exchange-traded fund. And at exactly 28 p.m., there was a block trade of 14 million shares. 14 million shares. That is not retail. That is not some guy in his basement buying silver on Robinhood. That is institutional panic buying. And it continued into the close. By 4 p.m., SLV had accumulated $63 million in net inflows in a single trading session. That is the largest single-day inflow since March of 2020, when the COVID lockdowns triggered the first wave of money printing. But the media is not telling you this. The media is telling you the price is going up because of investor sentiment or inflation fears. They are lying to you. This is regulatory-driven forced liquidation. This is Basel III enforcement creating a liquidity cascade in the paper markets. Now let me explain the exact mechanics of what these banks are facing, because this is critical. Under the NSFR calculation, the BIS categorizes assets based on their stability and liquidity over a 1-year time horizon. Tier 1 assets, which include cash, central bank reserves, and allocated physical gold and silver, require 0 additional capital reserves because they are considered stable and liquid. Tier 2 assets, which include corporate bonds, high-grade sovereign debt, and some equities, require partial reserves depending on the volatility rating. But unallocated precious metals, as of Monday, are being reclassified as Tier 3 high-volatility assets with an 85% required stable funding ratio. Now, what does that mean in plain English? It means if you are a bank and you are holding a 10 billion short position in paper silver futures, you now need to have $8.5 billion in Tier 1 capital, meaning cash or physical reserves sitting on your balance sheet to justify that position. And most of these banks do not have that capital. They have been operating on leverage. They have been operating on the assumption that they could roll over their short positions indefinitely without ever having to deliver physical metal. But the BIS just changed the rules, and the banks that do not comply by Monday morning are going to be cut off from the global banking system. So what are their options? Option 1, they liquidate their short positions by buying back the futures contracts at market price. But if they do that, they are going to drive the price of silver through the roof because there is not enough sell-side liquidity to absorb that much buying pressure. Option 2, they take delivery of physical metal to convert their unallocated paper positions into allocated physical positions, which would qualify as Tier 1 assets. But as I just showed you, there is only 64 million ounces of registered silver in the COMEX vaults, and they need billions of ounces to cover. Option 3, they raise $8.5 billion in fresh Tier 1 capital by selling other assets, issuing bonds, or begging the Federal Reserve for a liquidity injection. But the Fed is not in a position to help right now because they are still trying to manage their own balance sheet after the repo crisis of late 2025. So the banks are trapped. They are in a zugzwang position. Every move they make leads to the same outcome. The price of silver goes vertical. And this is not speculation. This is not a conspiracy theory. This is math. Let me walk you through the exact numbers again because I want you to understand the scale of what is coming. The total global above-ground silver inventory, meaning all the silver that has ever been mined and is currently sitting in vaults, government reserves, ETFs, and private holdings, is estimated at around 2 billion ounces. Now that sounds like a lot until you realize that the total paper claims on silver, including COMEX futures, London unallocated accounts, synthetic ETFs, and over-the-counter derivatives, is estimated at over 30 billion ounces. 30 billion ounces of paper claims on 2 billion ounces of physical metal. That is a 15-to-1 leverage ratio on a global scale. And on Monday morning, the BIS is forcing the banks to reconcile that imbalance. They are forcing the paper market to confront physical reality. And when that happens, the price is going to reflect the true scarcity of the metal, not the fake supply that has been created by fractional reserve bullion banking. Now let me connect this to the bigger picture because this is not just about silver. This is about the entire dollar-based financial system. The reason the BIS is enforcing these rules right now in February of 2026 is because they know the system is on the verge of collapse. They know that the repo market crisis of 2019 never actually got resolved. They know that the Fed's balance sheet is still sitting at over $7 trillion after the emergency interventions of 2020 and 2023. They know that the commercial real estate market in the United States is imploding. They know that the Treasury market is showing signs of illiquidity, and they know that the only way to prevent a full-scale banking panic is to force the banks to hold real assets, Tier 1 assets, instead of paper derivatives. So what they are doing with the NSFR rule is essentially saying, if you want to stay in the system, you need to prove that your balance sheet is backed by real value, not synthetic leverage. And that is why precious metals, allocated physical precious metals, are suddenly becoming the most valuable asset class on the planet. But here is the part that is going to blow your mind. The banks know this, the central banks know this, the BIS knows this, and they have been preparing for this moment for years. Let me give you some context. In 2019, the BIS reclassified physical gold as a Tier 1 asset for the first time in modern banking history. Before that, gold was considered a Tier 3 asset, just like stocks or commodities. But in 2019, they changed the rule. They said physical gold held in allocated accounts is now equivalent to cash. And at the time, nobody in the mainstream financial media paid attention. It was buried in a footnote of a quarterly BIS report, but the central banks paid attention. And what did they do? They started buying gold. In 2022, central banks bought over 1,000 metric tons of gold, the highest level in 55 years. In 2023, they bought another 1,037 metric tons. In 2024, they bought 984 metric tons. And in 2025, the buying accelerated even further, with China alone adding over 400 metric tons to its official reserves. And that is just the reported number. The actual number is probably double that when you account for off-balance sheet purchases through proxy entities. So the central banks have been front-running this regulatory shift for the last 6 years. They knew the NSFR rule was coming. They knew that physical precious metals were going to become the only Tier 1 asset that could not be inflated away by a central bank, and they positioned themselves accordingly. Now, I need you to go to the comments section right now and tell me what you are seeing at your local bullion dealer. I am not asking you to do this out of curiosity. I am asking you to do this because I need to verify what the data is telling me. The data is telling me that physical premiums are exploding. The data is telling me that dealers are sold out of Silver Eagles, sold out of Maple Leafs, sold out of generic rounds. But I want to hear it from you directly. Go to your local dealer this weekend. Call them, walk in, ask them, do you have silver? What is the premium over spot? And then come back to this video and post it in the comments, because I guarantee you the dealers are going to tell you the same thing they told me when I called 3 different shops yesterday afternoon. They are going to tell you we are sold out. We have a 6W WeekEx backlog, and the premiums are the highest we have ever seen. And that is the physical reality that the mainstream media is ignoring. The spot price on your screen, the $29 or $31 or whatever it says on the COMEX ticker, that is the paper price. That is the fake price. The real price, the price you actually have to pay to take possession of physical metal, is already 10 to 15% higher. And by Wednesday of next week, after the banks have spent 2 days scrambling to comply with the NSFR rule, I would not be surprised if that premium is 30% higher. And now, let me tell you who the villain is in this story. It is not the Federal Reserve, although they are certainly complicit. It is not the Biden administration or the Trump administration or whoever is in power. The villain is the algorithm. The villain is the high-frequency trading system that has been used to suppress the price of precious metals for the last 15 years. Let me explain how this works, because this is the smoking gun. When you look at the price chart of silver, especially during New York trading hours, you see these massive vertical drops that happen in seconds. You see the price go from $30 to $28 or $50 in a 90-second window, with no fundamental news, no data release, no macroeconomic event. And the mainstream explanation is always, oh, someone hit a stop-loss cascade, or there was a liquidity gap, or it was just normal volatility. That is a lie. What is actually happening is algorithmic spoofing. The big banks are using high-frequency trading algorithms to flood the order book with fake sell orders, creating the illusion of massive supply, and then pulling those orders at the last second after the price has dropped. This is a technique called quote stuffing, and it is illegal under the Dodd-Frank Act, but the banks do it anyway because the fines are negligible compared to the profits, and they have been doing it every single day for over a decade to keep the price of silver artificially low. But here is the problem. The algorithm only works if the banks have unlimited ability to create synthetic supply through futures contracts and unallocated accounts. Once the NSFR rule kicks in on Monday and forces them to back their paper positions with actual capital or physical metal, the algorithm breaks. They lose the ability to flood the market with infinite sell orders because every new short position they open is going to require 85 cents on the dollar in Tier 1 reserves, and they do not have that capital. So the suppression mechanism that has been holding the price down for 15 years is about to disappear. And when it disappears, the price is going to reflect true supply and demand for the first time since the year 2000. Now let me take you back in history for a second, because this has happened before. In 1933, Franklin Delano Roosevelt signed Executive Order 6.12, which made it illegal for American citizens to own gold. The government forced everyone to turn in their gold at the official price of $20.67 per ounce, and then immediately revalued gold to $35 per ounce, effectively confiscating 25% of the purchasing power from anyone who complied. But here is the part they do not teach you in school. The reason Roosevelt did that was because the banking system was insolvent. The banks had been operating on fractional reserve gold banking, meaning they had issued far more paper claims on gold than they had actual gold in the vaults. And when people started demanding physical redemption during the bank runs of 1932 and 1933, the whole system collapsed. So Roosevelt's solution was to confiscate the gold, consolidate it in government hands, and then revalue it higher to recapitalize the banks. It was a wealth transfer from the public to the financial system. And we are about to see the same thing happen again, except this time it is not the government confiscating your gold. It is the regulatory system forcing the banks to confiscate it from the paper markets. Fast forward to 1971. Richard Nixon closes the gold window and ends the Bretton Woods system. And the official explanation is we needed to stop foreign governments from draining our gold reserves. But the real reason, the reason they do not tell you, is that the United States had issued far more dollar claims on gold than it had gold in Fort Knox. France under Charles de Gaulle figured this out and started demanding physical gold redemption for their dollar reserves. And when other countries started following suit, Nixon realized the game was over, so he closed the window, defaulted on the gold backing, and turned the dollar into a pure fiat currency backed by nothing. And what happened to the price of gold after that? It went from $35 an ounce in 1971 to $850 an ounce by 1980, a 24 times increase in less than a decade. Because once the paper claims were severed from the physical asset, the price had to reflect actual scarcity. And now we are at the same inflection point with silver. For the last 20 years, the banks have been operating a fractional reserve silver banking system through the COMEX and the London Bullion market. They have issued 30 billion ounces of paper claims on 2 billion ounces of physical metal. And the system has worked as long as nobody demanded physical delivery. But the NSFR rule is forcing the banks to either deliver physical or back their paper with massive capital reserves. And when that happens, the fractional reserve system collapses. The paper price and the physical price diverge. And the real price, the price that reflects actual supply and demand, goes parabolic. Now let me connect this to the geopolitical angle, because this is where it gets really interesting. While the Western banks have been playing games with paper silver, China has been quietly accumulating physical. And I am not talking about small amounts. I am talking about strategic nation-state level accumulation. Let me give you the numbers. In 2024, China imported over 7,000 metric tons of silver, which is approximately 225 million ounces. That is over 25% of total global mine production in a single year. All going into one country. And where is that silver going? It is not going into jewelry. It is not going into industrial applications. It is going into government vaults. It is going into strategic reserves. Because the Chinese Communist Party understands something that most Western investors do not understand. They understand that silver is not just a precious metal. It is a strategic industrial metal that is absolutely critical for the green energy transition, for solar panels, for electric vehicles, for 5G infrastructure, for military applications. And they understand that the West has been suppressing the price for decades by manipulating the paper markets. So what are they doing? They are buying as much physical as they can, while the price is still artificially low. And when the price finally breaks free and goes to its true value, China is going to control the majority of the global supply. And it is not just China. Russia has been doing the same thing with gold. India has been doing the same thing with gold and silver. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members, Saudi Arabia, UAE, Iran, Egypt, Ethiopia, they're all moving away from dollar-based reserves and into hard assets. And the reason they are doing this is because they know the dollar system is terminal. They know that the United States has over $35 trillion in national debt. They know that the Fed's balance sheet is bloated beyond repair. They know that the Treasury market is showing signs of dysfunction. And they know that the only way to protect their wealth from the coming currency collapse is to hold physical assets that cannot be printed, cannot be diluted, and cannot be confiscated by a foreign government. So what is happening right now with the Basel III NSFR enforcement on Monday is not just a banking regulation. It is a geopolitical realignment. It is the BIS, which is controlled by the central banks of the Western world, essentially admitting that the paper-based financial system is broken and needs to be backed by real assets. And the countries that have been accumulating those real assets, China, Russia, India, the BRICS bloc, are going to emerge from this crisis as the new financial superpowers. The West is going to be left holding worthless paper while the East holds the physical gold and silver. And that is the great wealth transfer that is happening right now in real time. And most people have no idea it is even occurring. Now, let me walk you through the timeline for the next 72 hours because this is critical. Right now, it is Saturday night, February 7th, 2026. The COMEX is closed. The London Bullion market is closed. The New York Stock Exchange is closed. But the banks are not sleeping.